Welcome to vTalkInsight, Risk Sentiment Daily for February 3rd, 2026. A historic crash in metals and rising doubts around AI spending are colliding with shifting central bank expectations, leaving investors to navigate a market that is jumpy but still very much in play. Across markets today, overall risk sentiment looks volatile and cautious rather than outright panicked. We are seeing some of the largest two-day moves in decades in gold and silver, sharp drops in crypto, and pressure in parts of tech, yet headline volatility in broad equity and bond indices remains relatively contained, and U.S. large caps even finished the last session higher. The tone of commentary points to a stress episode driven more by stretched positioning and technical factors than by a sudden macro shock. Parabolic rallies in precious metals, speculative flows from retail and ETFs, and crowded thematic trades are now unwinding, causing 2 to 3 standard deviation swings in commodities, while spillover into rates and currencies is still limited. Compared with late last week, when sentiment had already shifted to cautiously risk-off, today feels like that narrative playing out in real time. Investors are trimming exposure to crowded trades, rotating toward defensives such as consumer staples, shortening duration, and leaning more on hedges, but wealth managers report that many clients are keeping long-term strategies intact and treating the pullback as a correction within an ongoing bull trend rather than a signal to exit risk entirely. The most powerful bearish force right now is the metals crash and speculative unwind. Gold has just seen its steepest two-day decline since the 1980s, with price drops of around $1,000 and moves of 8 to 10% being cited, while silver has fallen as much as 40% in 3 days and briefly turned negative for the year. These reversals come after an unsustainable, speculative surge driven by retail investors, ETF inflows, and leveraged futures positions, particularly out of China. Commentary notes that gold rallies had increasingly shifted from steady central bank buying and geopolitical hedging to momentum trading, amplified by record volumes, higher leverage, and, most recently, margin hikes that triggered forced liquidations across precious metals and related mining equities. This unwind is creating a classic liquidity squeeze in a crowded corner of the market. Metals and mining stocks in Asia and Europe are under heavy pressure. Option-implied volatility has spiked, and there are growing concerns that if gold were to fall another 10%, fund-level knock-on effects could emerge, pushing risk reduction into other trades such as tech and AI, or even into private assets and crypto, where speculative retail participation has also been high. For now, the damage is concentrated in commodities and commodity-linked equities, with only modest volatility in treasuries and the dollar, suggesting that broader contagion is still contained. The key watch point from here is whether ETF outflows, margin calls, and professional exposure to gold trigger a second wave of deleveraging, or whether fundamental buyers such as central banks and long-term allocators begin to stabilize the complex once the dust settles. The second major bearish driver is AI and tech capex skepticism, which is eroding confidence in the market's primary leadership group. After a year where AI narratives powered outsized gains in platforms, semiconductors, and cloud, investors are now questioning the scale and timing of returns on massive infrastructure commitments. One flashpoint is Oracle's plan to raise $45 to $50 billion this year, split between equity-linked and bond issuance, to fund data center and AI infrastructure commitments. The announcement has pressured the stock, which is already down roughly 50% from its 2025 peak, widened its credit default swaps, and raised alarms about negative free cash flow, high leverage, and the absence of sovereign wealth fund or private equity backstops for such a large program. At the same time, a major tech company has flagged a similar $50 billion financing need, prompting questions about whether these enormous capital budgets can earn adequate returns. NVIDIA's chief executive has stepped back from earlier talk of $100 billion commitments to OpenAI. Funding announcements from hyperscalers have met with more muted share price reactions, and AI-related software names are under pressure as promised margin benefits have yet to fully materialize. All this is feeding a tech-led drawdown just as earnings season disappoints, with S&P beat rates and positive revisions both falling versus last quarter, and with some investors openly worried that AI capex may peak and decelerate by 2026. If upcoming results from bellwethers such as Alphabet fail to reassure on AI monetization, the risk is that a narrative about overinvestment and circular funding loops further undermines the sector's leadership role in global risk assets. The third key headwind comes from Hawkish Fed and liquidity concerns. The potential appointment of Kevin Warsh, a long-standing critic of the Fed's expanded balance sheet, is reinforcing expectations that the central bank could prioritize inflation control and balance sheet reduction over rapid rate cuts. Several observers warn that a shift toward a smaller balance sheet and faster quantitative tightening would reduce market liquidity and could be particularly negative for long-dated treasuries. Portfolios are already positioned with their lowest duration in 3 years, avoiding the long end of the U.S. curve and favoring assets with higher real yields such as UK gilts and select emerging market local bonds, reflecting anxiety that bond markets are underpricing the risk of an inflation resurgence. Markets still price 2 to 3 rate cuts this year, and some strategists see downside risk in upcoming non-farm payrolls that could accelerate those expectations. But there is also a clear warning that sticky prices or a re-accelerating labor market could clash with the Fed's desire to ease. That tension, combined with talk of Fed and G10 policy divergence and the dollar's likely near-term strength, keeps a layer of policy risk and FX volatility hanging over risk assets and raises the stakes for any further shock coming out of the metals or tech complex. On the bullish side, copper and energy transition demand provide an important counterweight to the current gloom. Although copper prices have dropped sharply alongside precious metals, with contango, high inventories, and weak Chinese premiums justifying the near-term correction, influential investors remain constructive on the metal over the next several quarters. The medium-term thesis is built on the scale of electrification and digitalization ahead. Copper is central to electric vehicles, grid upgrades, renewable installations, semiconductor production, and data center expansion, including the AI infrastructure build-out that underpins cloud and hyperscaler demand, while structural supply challenges and missed production targets in key producers, such as Chile, limit the ability of mines to respond quickly. Related themes support a similar, if slightly more nuanced, case for silver, where industrial and renewable demand and a market deficit underpin a constructive medium-term outlook despite current volatility. For portfolios, this suggests that while the positioning washout in metals may not be over, the longer-term risk-reward in selected miners and industrial metals looks more anchored in fundamentals than the recent price action implies, offering a potential buffer against a broader collapse in commodity sentiment. A second important bullish driver is policy support and Fed backstop hopes, which continue to temper how far investors are willing to de-risk. Despite worries about a more hawkish chair, many market participants still assume that, in the face of real economic stress, policymakers would lean against a deep downturn, whether through monetary easing, fiscal stimulus, or regulatory forbearance. Markets currently embed expectations for a first Fed rate cut around mid-year, with 2 to 3 moves priced in for the calendar year, even as that path remains highly data-dependent. Some analysts flag that changes to the U.S. payrolls methodology could deliver a surprisingly weak, or even negative, jobs print, which in turn might reinforce rate cut expectations and cushion risk assets after this bout of volatility. Interestingly, gold and silver prices have fallen and the dollar has strengthened on news of Warsh's possible nomination, a reaction interpreted by some as renewed confidence in Fed credibility and a reduced tail risk of uncontrolled inflation or dollar debasement. Together with persistent beliefs in various forms of a policy put, this helps explain why, even as crowded trades unwind and volatility spikes in metals and FX, broader equity and credit markets are showing resilience rather than a disorderly capitulation. The final bullish force is AI-driven growth and fiscal tailwinds, which continue to support the medium-term case for risk assets even as sentiment around capex has cooled. AI-related equity gains in the US have so far been grounded more in earnings delivery than in pure multiple expansion, and there is a growing view that future market leadership may shift toward firms that can demonstrate tangible cost savings and productivity gains from AI adoption. Recent commentary also points to an ongoing rotation beneath the surface. Even as leading AI names have paused, there are signs that the rally is spreading into a broader set of sectors, while upward pressure on AI-linked commodities such as copper is expected to return once the current or risking phase fades, reinforcing the idea that AI is more than a narrow mega-cap story. On the macro side, anticipated German fiscal stimulus is highlighted as a potential catalyst for stronger European growth this year, improving the region's relative prospects versus the US and supporting banks, cyclicals, and exporters. Combined with targeted budgets in countries like India to support strategic sectors such as semiconductors and exports, these fiscal efforts offer a counterbalance to the present volatility, suggesting that the global growth backdrop may remain supportive enough for risk assets once the current position shakeout has run its course. To sum up, today's risk backdrop is defined by violent moves in crowded trades, especially in metals and parts of tech, set against more stable macro foundations and still supportive policy and growth narratives. Metals crash and speculative unwind, AI and tech capex skepticism, and hawkish Fed and liquidity concerns are pushing investors to be more selective and defensive, yet long-term copper and energy transition demand, policy support and Fed backstop hopes, and AI-driven growth with fiscal tailwinds continue to anchor risk appetite. From here, the key signals to watch are whether deleveraging spreads beyond commodities into core equities and credit, how the Fed balances inflation risks with easing expectations, and whether upcoming earnings and data can validate or challenge the AI and growth stories that have led markets so far. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.